It is Wednesday, January 2nd, 2019. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was a very educational, get your ass kicked at Jiu-Jitsu Wednesday. We started off doing stuff from the back, where you've already got the back. We started with a little bit of scissor choke action, or not scissor, zipper choke. That's it. Zipper choke action, and then we transitioned on over into some clock choke action, and both of those I found very fun. Honestly, the clock choke I thought was going to be a little more difficult, but after I figured out how to get my legs around to the right position, it actually felt like a more secure, more definitive choke for me. And it seemed my opponent definitely felt it. And I got the rare opportunity to roll with a purple belt for my last roll session for the night. And it was really educational. I mean, like, I managed to keep a lot of good pressure on him, and I managed to negate a lot of the things that he was trying to set up. And I don't know if it was just because he was going slower, because I'm a lower belt and whatnot. But I did manage to get some really good escapes in. We were doing positional sparring with the person already on your back, and the goal, of course, was to escape. And I've said it a few times on this show that I'm not particularly averse to having somebody try and take my back, because if they don't actually have a nice secure grip around my throat, I still have a lot of options that will cost them a lot of energy in trying to maintain their position. And so it's one of those places where your opponent will 9 times out of 10 try to apply a lot of strength in retaining their position and trying to impose their will and get that choke. And by that time, you're 2/3 into the choke by just having their back. And so it's just that last bit of the deal to seal. And so everybody gets really excited at that point. And it's a lot harder to retain your objectivity, And so the tendency on me, at least, seems to be that people really, really tire themselves out trying to hold on to that. And I guess that's, like I said, that's one of the reasons why when I'm put in that position, I do feel like in distress. It's not a safe position to be in, not by any means. It's the second most dominant position in jiu-jitsu. The full mount, of course, being the first. But just the same, at the same time, there's a lot of tools right in front of you. Like, I like to go for people's feet with my hands. Like, if I can lean forward and grab your ankles, I like that. Because if I can pull up on your ankles, or just pull up on one of them, I'm halfway out of your guard, or out of your hooks, and so when you lean forward, it'll pop their toes a little bit off of your thighs, and you just hook your hands in there and just lift up, and then pick one of them and put 2 arms on one, and you don't even really have to lift it up very far. You just have to lift it up far enough to get that arm in. And you can change that whole game of dominance if you can get your hands under one of the hooks. It's not a good position to be in. You don't want to live there forever, but it'll get you that much further to getting the fuck out of that position. And see, one of the things I really like to do, and I described this on the last show, is that I really like to switch from somebody having my back to getting it flat on the ground and me in a half guard. I mean, that's like ultimately where I'm trying to go with it. And I managed that, and I managed a couple other things, but my opponent did get me in a good armbar, and I mean, it was slick. I just barely saw it coming, and I didn't get my arm out fast enough. He had really good control of my wrist, and so yeah, he just snatched it right out of the air. So I did correct it though. He made two other attempts at an armbar from me, turning into him and getting past his legs first. And that's not exactly the best way to try and get out, because again, it does put you at a risk for that armbar. But if you can get your arm in a decent enough position, or get it across the thigh or something like that, it's a lot easier to recover it if you can get on the good side of their legs. If you can get yourself turned over and just maybe on the side or something like that, to where you have your opponent turned on their side and just the one leg up over your hip, and trying to work that out of there. Anyway, he did get me in a good armbar though, and so like I said, it's like that was one of those educational moments. It's like, okay, I'm going to make sure that I pull my elbow tighter to my hip as I'm trying to negotiate my way out of this, even if he has grip of the wrist. And I almost like it when they do retain the grip. If I can get my elbow, the inside of my elbow, down past their hamstring, I really kind of like it if they hold on, because that gives me access to their wrist. And if I've got them turned mostly in a turtle with my arm only halfway through their legs, I like to grab onto their wrist and pull it through. Pull their shoulder towards their knees, and by the time you're in that position, you can start to push yourself with your other hand and put some pressure on their backside, right? And so that again, you're compressing their shoulders to their knees, or their knees to their shoulders rather, and their head. Okay, and then if you can get their hand out far enough, swap grips. Now you're completely on the outside of them, and you're open on the top side to start attacking the neck. After you've got your pressure on them, on their backside of their hip, and you've got a hold of that hand on the like say their right hand, and you got the pressure on their right hip. You got that right hand in between their legs. They're not going anywhere. If you can get it by either the sleeve or by their wrist, and you hold on to that, then you can start working up towards that head and start working towards the neck. And that's at least my tendencies. I like to try and crowd the head in and hold it in as tight as I can while I get my arm around either their shoulder or up around their neck, or maybe even on their lapel. Start working towards that what do you call it, bow and arrow choke. I mean, because you could achieve it from there. If you had a good hold of that wrist and good pressure on the hip, you could reach down, grab the left lapel, right, with like a backhanded kind of grip there, to where your thumb is facing down towards their feet and your pinky is up there towards their chin, right? And then reach down and grab one of their feet with your leg planted right in the mid of their back and just lean back. I think maybe I'll try that next time. Because if I've got that top arm down, they've got the arm underneath to maybe try and keep me from grabbing onto that lapel. But if I'm that slick and I manage to get their arm kind of tucked under their body, that might be a little additional to work for, because then you have both arms isolated and you got one arm free to readjust the position. Of course, you'd want to have like one leg in their back, like your left leg in their back, and like take your right leg and put it over their left ankle. You could probably get a bow and arrow choke just like that, and then just let go of the arm and lean back and kind of force your shin into their lower back. I don't know. I might have to try that next time. Give myself ideas already. But yeah, so like I said, it was a really, really educational rolling session. I felt like I got a lot out of it, and I did notice also that I wasn't breathing as hard at any time in this class, and I've been trying to do this where I run just like a quarter mile or so before I even go to class. And I added on top of that a little bit of time on the rowing machine. And so I think that's giving me a little more endurance in my arms. But I definitely feel better after I've gotten that quarter mile in. I don't know if it's just warming up my cardiovascular system or, I don't know, the persistence of it. Because, there's a lot of ups and downs in jiu-jitsu. And there's a lot of opportunities to take a breath, and realign yourself before you really get aggressive again. But, yeah, like I said, I feel like I get a better rolling session in if I do that quarter mile or so before I roll. I'm definitely going to be looking to get more of that in. Maybe even on my days off too. So, yeah. Gonna try and be a little more aggressive this year in 2019. We'll see how it works out for me. Anyway, let's go ahead and throw down into some music. And I haven't been playing as much of the really heavy, fast stuff on this show. And I feel that might be just a mild disservice that I'm doing, kind of misrepresenting metal. I'm gonna have to correct that. And so here it is, the Black Dahlia Murder, Widowmaker, First Dance, here on Coin Metal. And that was Meshuggah with Combustion. Let's see, somebody call me here on Discord really quick here. Yo! That was me responding. Anyway, I just caught a rare treat on my Twitter feed. and I replied, I think, appropriately. And let me see if I can bring that up really quick here. Because I do have stuff planned today. I do have some stuff planned, kinda. I don't know, I had a lot of time to accumulate tabs on the old browser here. And I just caught this on my Twitter feed here, and it was from CoinLook. If you're following them on Twitter, you might want to give that a go. Anyway, here it is. And this is just the title. Crypto critic Rubini, Trump's flirting with mutually assured economic destruction. And so my response to it was, I never thought I'd see the day when someone of Rubini's stature would go cribbing my jibes, but that day has come. Let me clarify it, though. I've often characterized cryptocurrencies, specifically where it pertains to regulation, as quote-unquote the mad quagmire of the 21st century. And I still stand by that. That's most assuredly what's going on. That they're all looking at one another going, well, are we going to work together against this thing? Are we going to let it proliferate and see exactly how it comes out? Do we really have a choice either way? What the fuck? And it's funny because we've read on this show where they've tried to find new definitions not actually created by us, like crypto assets or digital assets or cryptographic assets or some shit like that, that doesn't actually describe and leaves out, omits a lot of things like design, differential. Is it proof of work? Is it proof of stake? Is it just a token, ICO token or whatever? But, and I just wanted to clarify again on something else. My perspective on ICOs did change only slightly. And this is where I think the SEC is kind of overstepping their bounds with regard to ICOs, is that unlike every single other derivative on planet Earth, unlike every single fucking one of them, there is no actual trust involved with regard to, does the ICO have the underlying assets that they were given? There's quite a bit more transparency with regard to that, because these people are given the money initially in Ethereum, right? That's on the Ethereum blockchain. The transaction involving the deposit thereof, it's there. It's on an immutable record. And so that's different than fucking gold certificates, any kind of paperized commodity or derivative thereof, or claim of ownership. This is when you sell those coins, the ICOs, they usually have some sort of like liquidation schedule that they have for their Ethereum that they intend to be, and they disclose that shit all well in advance, and they tell you why specifically too. They're like, dude, we need this shit for ops so we can keep the lights on and we can keep deving and all that other shit, and we can support the coin. That's what that ICO stuff is there for, is for them to get that initial leg up. There's a lot of projects out there that abuse it, though, because everybody gets excited about the idea of quote-unquote ICOs, and they can get in on the ground floor, and they can, make all kinds of money and turnkey, and people keep hearing buzzwords and bullshit, and they buy it. Only because they don't know the difference between the bullshit that they're being fed and the real deal. And this always happens, though. This is part of the evolution of any person investing themselves or their attention or their money or their hardware or anything else into cryptocurrencies, is that they have that initial issue that, they run into a brick wall now and then. It doesn't work out exactly as the person that sold it to them as. That there's some bait and switch, there's a lot of omissions, there's a lot of non-disclosed PETA, other considerations that were omitted. These things happen. And the only way to learn it is to actually experience it yourself. If you rely on other people to experience it for you, you never learn the lesson. And so you invariably will get run into the wall, either by the person doing it for you or yourself when you have to take the reins because the other person got fucking wrecked. That's all there is to it. There is no shielding yourself from the quote-unquote volatility of transitioning from a national fiat currency into a cryptocurrency. You just can't fucking do it, man. You just got to learn by actually doing the transactions themselves and what's involved to know what the value is of it. If you've done an on-chain transaction and seen how quickly it transacts and how quickly it confirms and gets to the person involved that with you in your commerce, after that you're just like, okay, I'm hooked, because this is like 8 billion times better than anything I've ever heard of or used other than quote-unquote cash in hand. Other than physical notes, this is the fastest fucking transaction I've ever seen. And given the consideration that the whole reason for coming into cryptocurrencies for some of us was because of devaluation of those paper notes, that they weren't necessarily buying everything that you needed them to buy, because the government or central bank that was issuing them had gotten kind of freaky with the issuing of them. Anyway, I kind of swore to myself that we would actually cover somebody else's project on this show today. And because, I did that initially on this show where I would talk about like altcoins and stuff like that, and I'd read their white papers and stuff like that. And this one, I think this is really pertinent, especially coming up. I think that we are headed for another alt bloom. And that's just like one of my periphery speculations, ideas that, I think that there are a lot more people interested in this than are actually participating in it at this moment. And that interest, I believe, is going to translate into software development and hardware development and moving this shit along to where more people can participate in it on a much more meaningful level than just bouncing transactions back and forth on somebody else's network. I think that's the perspective of cryptocurrencies for some people, and a lot of people get hung up on the whole layer 2 thing with regard to getting transactions into blocks and all that business, and how that's going to limit the capacity of quote unquote Lightning. Well, it's not exactly true. See, first you set up the quote-unquote layer 2, and then you quote-unquote build on top of it. Now, what you have to understand is that what's being proposed is being proposed to be built on top of other people's work. People like you, people like me, who are supplying hashing power, bandwidth, and electricity to the effort of mining coins, is where all the backbone for all this shit comes from. Now, I'm sure that there are some people out there that expect that there's going to be a institutional takeover of mining. And where I see a flaw in that ideation is that cryptocurrencies only have their level of interest because we can participate in them. If we couldn't mine it, it wouldn't have any interest for us. You know, if we couldn't devote some of our effort, some of our stake to it, what good would it be to us? And that's where altcoins come in. And I expect that in the not so distant future, there's going to be some sort of event, you know, whether it be Bitcoin mooning or some shit like that, that is going to cause transaction fees on the Bitcoin network to get excessively high. And in addition to that, I expect there to be an additional kind of media push for Lightning and third parties that are doing that shit. I mean, and I'm seeing that already now. And then, in about a year or so, they're going to hammer down on them like they did, you know, like the SEC and ICOs. They didn't have shit to say about ICOs for like at least 16 months before, you know, where there was like the massive foamy frothy shit where people were making like, you know, hundreds of millions of dollars within a day or two, you know, and it was obvious that the shit was getting kind of crazy. But to me, that just indicated an expression of interest in these kind of projects. But anyway, all that shit aside, I expect that this confluence of events is going to expand cryptocurrencies in general, because people are going to look at the options available. The altcoins that have shown themselves to be able to weather the storm and stay around the longest are probably going to receive some additional support on their networks by miners. And then in addition to that, people are going to be looking around at other aspects of mining or other ways of mining, and they're going to be experimenting in those and combining a lot of the lessons that we've learned over the last decade and trying to derive better outcomes from the lessons learned. We haven't gotten self-reflective yet. And I think it's because we've had a wealth of interest and a wealth of fiat currencies being printed up everywhere. And that's been kind of driving the focus off of being self-reflective. But I believe there is a point, and in the not so distant future, where the organic interest in this and the available knowledge base and brain power that's out there will learn how to dev this shit. We'll learn how to alter the incentives and whatnot in a way that they believe is better than the existing ones available. And they'll get some interest, and they may achieve some sort of parity or excess of anything that's available right now. We don't know. And we can't really foresee that much in the future, but I do believe that there's a potential for this confluence of events where people are going to notice that their custodial accounts are getting a little more expensive than they had previously been sold on, and they're no longer able to interact directly with them, but then they can interact with some sort of like thing through a bank or some such like that, where, you know, there's this layer of state approved bullshit that they'll be able to interface with. And so then you'll be on layer 3, and you'll be transacting solely in IOUs, not even in representations of Bitcoin on the blockchain, but representations of that. And I think that's really, really dangerous. I mean, considering that it is a network that is dependent upon our participation in it. If too few of us are participating, you get kind of like a monoculture of of interest, where they're only looking out for their own interest and whatnot, and we're kind of rewriting history behind the books, because they've got 3 layers of abstractions to fuck around with. 2 of them you have no idea about. and it all looks kosher, and it'll look kosher for as long as you can look at it. And then, people won't be watching it too much after that. But see, I think by then we've already kind of seen how this plays out a few times, where the pool of interest will get really, really tiny. People will reflect negatively on that because they can see the inherent danger in it, and they're just like, fuck that, I don't want to play that way. And I think there's a lot of that going on out there, especially with regard to Lightning and other off-chain options like that. It's like, look, we jumped off of the custodial model to get to where we are. Now, why do we want to jump back onto a fucking custodial model? What's the benefit of that? I got somebody else now that can tell me when and with whom I can transact. Fuck that. Anyway, so I got this paper here. It's about 18 pages long, just long enough for us here. And so here it is. SOK, Research Perspectives and Challenges for Bitcoin and Cryptocurrencies. And this is authored by, let me get something here really quick. Blah, blah, blah. This is by Joseph Bonu, Andrew Miller, Jeremy Clark, Arvind Narayanan. My apologies, sir. Joshua A. Kroll, Edward W. Felton, Princeton University, Stanford University, Electric Frontier Foundation, University of Maryland, and Concordia University. So yes, penis, no vagina. Abstract. Bitcoin has emerged as the most successful cryptocurrency or cryptographic currency in history. Within 2 years of its quiet launch in 2009, Bitcoin grew to comprise billions of dollars of economic value despite only cursory analysis of the system's design. Since then, a growing literature has identified hidden but important properties of the system, discovered attacks, proposed promising alternatives, and singled out let's see here. Where does I had to increase the size of it there. Singled out different future challenges. Meanwhile, a large and vibrant open source community has proposed and deployed numerous modifications and extensions. We provide the first systemic exposition, Bitcoin and many related cryptocurrencies or altcoins. Drawing from a scattered body of knowledge, we identify 3 key components of Bitcoin's design that can be decoupled. This enables a more insightful analysis of Bitcoin's properties and future stability. We map a design space for numerous proposed modifications, providing comparative analysis for alternative consensus mechanisms, currency allocation mechanisms, computational puzzles, and key management tools. We survey anonymity issues in Bitcoin and provide an evaluation framework for now analyzing a variety of privacy-enhancing proposals. Finally, we provide new insights on what we term disintermediation protocols, which absolve the need for trusted intermediaries in an interesting set of applications. We identify 3 general disintermediation strategies and provide a detailed comparison. 1. Why Bitcoin is worthy of research. Considering 2 opposing viewpoints on Bitcoin in strawman form. The first is that, quote, Bitcoin works in practice but not in theory. At times, devoted members of the Bitcoin community espouse this philosophy and criticize the security research community for failing to discover Bitcoin and not immediately recognizing its novelty, and still today dismissing it due to the lack of rigorous theoretical foundation. A second viewpoint is that Bitcoin stability relies on an unknown combination of socioeconomic factors, which is hopelessly intractable to model with sufficient precision, failing to yield a convincing argument for the system's soundness. Given these difficulties, experienced security researchers may avoid Bitcoin as a topic of study, considering it prudent security engineering to only design systems with precise threat models that admit formal security proofs. We intend to show where each of these simplistic viewpoints fail. To the first, we contend that while Bitcoin has worked surprisingly well in practice so far, there is an important role for research to play in identifying precisely why this has been possible, moving beyond a blind acceptance of the informal arguments presented with these systems' initial proposal. Furthermore, it is crucial to understand whether Bitcoin will, quote, still work in practice as practices change. We expect external political and economic factors to evolve. The system must change if and when transaction volume scales, and the nature of the monetary rewards for Bitcoin miners will change over time as part of the system design. And I'd like to just stop right there and just indicate one thing. It's my contention that quote-unquote scalability is best achieved with adoption. The more people mine, the better it will work. Continuing on. Let's see, monetary rewards. It is not enough to argue that Bitcoin has worked from 2009 to 2014 and will therefore continue likewise. We do not yet have sufficient understanding to conclude with confidence that Bitcoin will continue to work well in practice, which is a crucial research challenge that requires insight from computer science theory. And one thing, I want to check and see if there's an actual date on this thing, because it said 2014 there, and we've kind of proven that it still works. Let's see here. I want to make sure that it isn't from 2014, because that's old. Let's see here, get it down to the bottom here. 2013, yeah, all the references are up to 2014. Yeah, this would be a retrospective to oh man. Anyway, I don't know. I think we should cover it. I mean, because there is some stuff that I can see on here that's, I don't know, I probably actually read this on this show already. All kinds of integrated and linkability. Nice. Yeah, I think I've actually covered this on the show before. Yeah, it's okay. We got 1,000,000,001 other fucking tabs open on my browser here, so I think we can cover it. I think we can get it covered. Well, this is kind of interesting. Let's go for it. It's on Altcoin Buzz. If I can get this thing to load. No! Apparently not. Proof of keys? What? Yeah, I know. Damn. Oy. Well, crap. The link apparently was not correct. And I'm having a little bit of difficulty. Oh, that's kind of interesting. Might have to go with that one. Yeah, let's go with that one. That seems interesting. But it looks like it might be aggregated from the Wall Street Journal. So, let's check with them and see if they'll actually let me read it. I want to read the full story. Don't fuck you people. Alright. We can't cover the original because Wall Street Journal requires that you actually subscribe to them, and I don't subscribe to you, Wall Street Journal. Continuing on. This is from altcoinbuzz.io. Wall Street Journal shares list of 513 ICOs without unique white paper. That's kind of interesting, huh? This is by Loose Lammers, or Lammers, December 29th, 2018. Kind of old, not really old. The years of 2017 and 2018 saw a huge boom in startups raising money via an initial coin offering. Soon, many countries around the world called for regulation to stop numerous scams to take advantage of inexperienced retail investors. According to government and institutions, the key problem with ICOs is that a vast number of them are scams or scam-like projects. Furthermore, a lot of tokens sold are actual securities, meaning that they violate U.S. securities law, forcing Securities and Exchange Commission to take action. That's actually bullshit. They kind of just overstepped their bounds and everybody decided to fall in line. Anyway, continuing on. According to government and institutions, the key problem with ICOs is that a vast number of them are scam-like projects. Got that part? To emphasize once more why cryptocurrency and ICO regulations are much needed, the Wall Street Journal reviewed 3,291 ICOs to check for duplication of their objectives, identity theft, and root out non-existent team members. The outcome? 513 of them are very risky or outright scam projects. According to the Wall Street Journal, 16% of the projects reviewed are potential scams and need further investigation. During the review, white papers were checked for plagiarism and originality. Furthermore, according to the Wall Street Journal, several criteria were used to judge each ICO, including the level of risk involved, duplication of words and phrases, inability to access their web pages, and fake team members on its board. Out of the 3,300 crypto offerings, 513 showed signs of plagiarism, identity theft, and promises of improbable returns. Some ICOs from 2017 and 2018 triggered a high level of suspicion. These ICOs were AdPerks, Acrocoin, Alphabet, Amor, Ape, BBN Coin, Battleball, and Bexang. Read the full report there. Let's see if it'll actually let me do that now. No, it takes me straight to Wall Street Journal. Fuck them. Anyway, so yeah, that's Wall Street Journal's perspective, I think, but you know, we've noted a lot of this shit on this show, that yes, there are plenty of ICOs that are just bullshit. But the question I think is most important is who are the people that are actually behind these? You know, it's like if we're finding that there's a plurality of the 513 scam coins or scam tokens in this case, is there a plurality of interest behind them? You know, is it like there's all like JP Morgan Chases behind, you know, 40% of them or some shit, and Goldman Sachs is involved in another 40% of them, you know, and then the 20% is just, you know, loose associated people that, you know, people have invested in just to follow in with the ICO craze. I think that these people weren't around for Alt Bloom 1. They're probably going to see some of it in Alt Bloom 2. Or 2.0 as I call it. But yeah, they just weren't around. There was plenty of this shit going on before, where there would be an altcoin released, and then there would be three that are kind of loosely kind of like it, and you know, the other two that were shit would fail, you know, after they had mad spikes, and then they had mad sell-offs following right behind, and people just lost interest in the coin because they didn't make any money. They weren't making any money off of mining it because they were getting dumped behind their back, you know. And I expect that to kind of happen again with regard to Alt Bloom 2.0. But this is part of the evolution. They're born, they live, they die. Or they keep living, one of the two. I mean, if you look out there at the, I think the last estimate that I read was somewhere around 2,000 live altcoin networks out there right now. If you were to take a good look at them, not very many of them were around since like 2013 through 2015. They've spawned like since then and grown to some sort of popularity in the last few years. But the projects that have been around that long and have persisted, shit like Dogecoin. I think Dogecoin has been around forever. Litecoin, even though people talk shit about it. I was looking at the metrics of Litecoin the other day, and it actually has way more transaction capacity than Bitcoin. It actually has four times as much. They have a 1 megabyte block on a 2.5 minute cycle. Their block limit is 1 megabyte, but their blocks complete in 2.5 minutes instead of 10 minutes. Somebody was trying to tell me that that's quote unquote less valuable. And I told them that it's just less expensive. There's a difference. If you've got a shit ton of miners out there, like Litecoin did have at one point. I don't know what the status is of their network now, but supposedly there's people still mining it. Anyway, as long as that continues, as long as people are still mining it, that's all that really matters. The network is live, the transactions can complete, and the better they work for people's use cases, the more likely they are to survive. And there actually has to be a real interest, a real motivation to use a particular cryptocurrency. Do you need fast transactions? Fuck, you're just as good off using Dogecoin or Verge. Something that has a really fast complete time. I don't see why not, But as far as how this is going to go, nobody can really tell you for certain. And as far as the Wall Street Journal is concerned, what they really ought to be looking at is the ICOs out there that have been burning their Ethereum, and look at which ones are actually retaining their reserves of Ethereum. I'm sure there's a few of those ICOs out there that are actually running on a lot of heart and initial investment and time and effort of volunteers, and not people getting really compensated by that Ethereum that they've got stashed on the blockchain backing up their tokens. If you were to look at that, you're going to find that there are some ICO mice out there that are eating the cheese and not bothering to try and figure out how to run the maze to keep getting more cheese. You're going to find that. But that's a better indicator to you, or should be a better indicator to you, of the seriousness of the project, and also, of course, the activity of the development community, and how much attention they're actually paying to their users. How serious are they? Are they actually putting out software, or are they just sitting around eating the cheese? Those are the determining factors, not this bullshit that there's a bunch of white papers with the same words in them. I mean, all of them are going to have the word token in it. All of them are going to have the word Ethereum in it. I mean, really, if that was your criteria, it would be 3,300 tokens instead of 513 that you're commenting about. So we don't even know the word criteria from this article, at least alone. Now if we had the Wall Street Journal, but they're behind a paywall, so they can go fuck themselves. That's just how that works. But nonetheless, I got this other article and I was really interested in it, but it seems like, it didn't give it to me. Bastards. Yeah, it keeps giving me this fucking error. 404. Don't see those very often, do you? Anyway, but yeah, I think the Wall Street Journal, if I had a better idea of what their search criteria were, or what their qualifying criteria were. What were the words that were repetitious? That's that's really important. Yeah, but we're gonna have plenty of issues like that. Oh, looks like Bitcoin's up a little bit, 39.24. Got this article here on CCN.com, and this one seems kind of interesting because there have been proof of keys quite a few times. Little events where people take custody of their keys and see if they can burn the big exchanges that are running on fractional reserves. And there's been some question previously about HitBTC's status as far as their funds are concerned, and so I'm not sure if this is just like FUD or whatever, but I think it's kind of interesting nonetheless. And this is authored on January 1st, 2019, 23:30 CET. Bitcoin exchange HitBTC freezes customers' accounts ahead of proof of keys event. Now, I just want to say we don't know if this is actually a related series of events, but we're going to find out, or at least what they're using to say that. Cryptocurrency exchange HitBTC has frozen its customers' accounts ahead of an annual proof of keys event, according to multiple sources. On December 31st, 2018, the company responded to an open complaint on Reddit after the user accused them of suspending his withdrawal requests. Redditor PedXS said he had dutifully passed the Know Your Customer test after waiting 6 months to access his HitBTC trading account. He confirmed that while he had withdrawn a large portion of his money already, he had still left some of it back in his public address for day trading. Quote, after months of sending 40 plus emails, HitBTC finally unfroze my account, PedXS said in his complaint. Quote, I immediately withdrew most of my funds but left a small amount to day trade. I did that because HitBTC promised that, quote, no further automated restrictions will be applied. Another Redditor using the alias Look at My IQ confirmed that he too faced withdrawal rejects at the behest of HitBTC. Excerpts from his complaint. Quote, submitted all my documents / evidence for KYC days ago, and now support is going cold on me. Have I been scammed? I have been trading crypto for years on all kinds of exchanges and never had my funds locked without warning like this. Support was fast to respond when asking for additional over-the-top information, but since then I have given them everything they have asked for, and they've just disappeared on me. A Redditor posing as the representative of HitBTC collected their charges and ensured immediate follow-ups. Funds frozen ahead of proof of keys event? PedXS doubted that HitBTC is intentionally locking users' accounts fearing massive coin withdrawals on the annual proof of keys event. To those who don't know, proof of keys is a movement started by renowned investor Trace Mayer that requests crypto traders to withdraw their funds deposited on a third-party service on every January 3rd. The purpose of doing it is to hold all of these third-party services accountable by testing them for their solvency. The movement is a way to detect whether or not crypto exchanges hold the funds that have been deposited into their private wallets in the past. Quote, over the months from day trading, I have built back my balance up to a couple of Bitcoin, complained PedXS. With the proof of key date approaching, I felt that HitBTC is the prime suspect for being insolvent, so I tried withdrawing my Bitcoin. Guess what? They blocked my withdrawal and froze my account again. Huh. Interesting. Quote, HitBTC was something that began as a promising crypto exchange and got lucky with the big crypto wave in 2016 and 2017, but it identically failed to keep up with the innovation and user demands, wrote Harsh Agrawal. Quote, they are barely surviving, and this can have a major impact on users who are using HitBTC as their crypto exchange. Technologist John McAfee also requested that people boycott HitBTC earlier in 2018. Quote, the crypto exchanges have become the thing that we originally fought against. Their power is immense. HitBTC, for example, has increased suffering for millions of poor people who cannot afford the minimum buy-in, since it is greater than their monthly income. Boycott them. You know, that's not really the same thing. And so, yeah. Anyway, I think this is kind of fudding. Actually, I think this is really fudding. Fudding HitBTC. We'll only see how they fare on the other side of it, you know? And I think they'll be just fine. But I did talk about this earlier, and I wanted to dig a little further into it. If the link will actually work, CCN, Jesus fuck. Come on. Damn it. Try reloading this thing. Maybe it'll help. Yeah. Okay. Here we go. And did we read this? No, we didn't. Oh, shit. Okay. And so here this is, I guess, authored 1 minute ago. Crypto critic Rubini, Trump is, quote, flirting with mutually assured economic destruction. In an article published on Market Watch, which we're just going to right click and make sure that we can just see if we can get the real deal. Yeah, why not? Cool. This is on actually Market Watch. I don't like actually reading stuff on an aggregated site. I like the original meat. And so here it is. Opinion. Rubini, President Trump is flirting with mutually assured economic destruction. This is published on January 2nd, 2019 at 8:53 a.m. Eastern Time. Now that financial markets see the danger of Trump's presidency, the risk of a financial crisis and global recession has grown. This is by Nouriel Rubini, New York Project Syndicate, rather. Financial markets have finally woken to the fact that Donald Trump is U.S. president. Given that the world has endured 2 years of reckless tweets and public statements by the world's most powerful man, the obvious question is, what took so long? For one thing, until now, investors had bought into the argument that Trump is all bark and no bite. They were willing to give him the benefit of the doubt as long as he pursued tax cuts, deregulation, and other policies beneficial to the corporate sector and shareholders. Actually beneficial to you, too. If you're not having to face all that regulatory friction, then you can get into business. Continuing on. And many trusted that at the end of the day, the, quote, adults in the room would restrain Trump and ensure that the administration's policies didn't jump the guardrails of orthodoxy. Actually, I don't care if they do that. Sorry, I had to rehydrate there. Rehydrate a little bit there. These assumptions were more or less vindicated during Trump's first year in office, when economic growth and an expected increase in corporate profits owing to forthcoming tax cuts and deregulation resulted in strong stock market performance. In 2017, stock indexes rose more than 20%. But things changed radically in 2018, and especially in the last few months. Despite corporate earnings growing over 20%, thanks to the tax cuts, U.S. equity markets moved sideways for most of the year and have now taken a sharp turn south. At this point, broad indexes are in correction territory, meaning a 10% drop from the recent peak. And indexes of tech stocks, such as the Nasdaq, are in bear market territory, a drop of over 20% or more. The financial market's higher volatility reflects concerns about China, Italy, and other Eurozone economies, the key emerging economies. Most of the recent turmoil is due to Trump. Now, most people are just blaming it on him. The year started with the enactment of a reckless tax cut that pushed up long-term interest rates. No, it didn't. The Fed pushed up long-term interest rates. Continuing on. And created a sugar high in an economy already close to full employment. As early as February, growing concerns about inflation rising above the Federal Reserve's 2% target led to the year's first risk-off. Then came Trump's trade wars with China and other key U.S. trade partners. Market worries and the administration's protectionist policies have waxed and waned throughout the year, but they are now reaching a new peak. The latest U.S. actions against China seem to augur a broader trade and economic and geopolitical Cold War. Actually, I have a difference of opinion here. I think that China representing themselves and their interest in the Middle East region when they deployed some troops over to Syria, That was an indication that they're kind of serious about Assad staying in Syria. And I think one of the calls, and I don't know if Rubini's actually going to cover this or not, but I think the call to withdraw U.S. troops out of Syria is kind of an indicator that we're done playing this game of just disrupting legitimate governments and having our proxies steal the oil out from under them. That's been going on, Mr. Rubini. That's one of the things that's been keeping gas prices really low is the gray market on oil. And that shit kind of came to a stop when Russia and China came to Syria's aid and said, we're done letting this shit go on. Anyway, continuing on. Then came Trump's trade wars with China and other key U.S. trade partners, and that's a miscall too. He's realigning us for the fact that we could not afford to continue to do the U.S. explorationism in Syria and on to Iran. We can't afford to do it. The fact of the matter is we're not going to be facing just them and their governmental forces. We would be facing Iran, China, and Russia. And while we can handle, we can maybe handle Iran, they haven't really been tested in a while, we would not be able to handle the forces of all three. It's kind of obvious. Writing's on the fucking wall, kids. Continuing on. An additional worry is that Trump's other policies will have stagflationary effects, reduced growth alongside higher inflation. That again is a miscall, I think. After all, Trump is planning to limit inward foreign direct investment and has already implemented broad restrictions on immigration, which will reduce labor supply growth at a time when workforce aging and skills mismatches are already a growing problem. And actually, that's because you've been trying to cut the tendons of everybody and cutting their interest out of the stake that they're participating in. You know, when you have Monsanto supplying like 20-30% of our food, that's a lot of fucking farmers that you put out of work. If they had the interest, the stake in growing the corn and the crops, we'd probably be producing a hell of a lot more than we are now, and we'd actually have more people employed. Continuing on. Moreover, the administration has yet to propose an infrastructure plan to spur private sector productivity or hasten the transition to a green economy. And that's not his call. He's the president. He handles the federal government, but he doesn't handle the state government. That's up for the states to figure out. We're supposed to be little test beds for stuff. Anyway, continuing on. And on Twitter and elsewhere, Trump has continued to bash corporations for their hiring, production, investment, and pricing practices. Yeah, because they keep hiring illegals under any other circumstances, under H-1B visas and student visas, getting them into the United States, paying them a third of what anybody can actually afford to live on, and we've got a growing homeless problem because of it. And nobody's willing to deal with that issue. So he's cutting back on the number of people that he's allowing into the country, and that's going to get some of the motherfuckers off the street and get them gainfully employed, because the corporations aren't going to have any choice. And I'm telling you right now, he's doing you all motherfucking favor. All right? Most of our oil is coming from fracking, and that shit is short term at best. We got like 2 to 5 years to make this green transition that Mr. Rubini is keyed on here. And one of the things that's really downplayed in our media, and I caught it on Joe Rogan Experience, is that solar has more fucking people employed right now in solar than coal. But we keep hearing about coal and fucking oil, right? But there's more motherfuckers in the green economy right now, just in solar, than there is probably in oil and coal. But we don't hear about that in the news. Anyway, continuing on. Moreover, the administration has yet to propose an infrastructure plan to spur private economic growth and blah, 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 blah. Trump has continued to bash corporations for their hiring, production, investment, and pricing practices, singling out tech firms just when they are already facing a wider backlash and increased competition from their Chinese counterparts. And that's going to slow down too, because China gets most of their ideas from us. Continuing on. Emerging markets have already been shaken by U.S. policies. Fiscal stimulus and monetary policy tightening have pushed up short and long-term interest rates and strengthened the U.S. dollar. As a result, emerging economies have experienced capital flight and rising dollar-denominated debt. Those that rely heavily on exports have suffered the effects of lower commodity prices, and all that trade even indirectly with China have felt the effects of the trade war. Even Trump's oil policies have created volatility. After the resumption of U.S. sanctions against Iran pushed up oil prices, and that's CLG9 is down to 2.13%, the administration's efforts to carve out exemptions and bully Saudi Arabia into increasing its own production led to a sharp price drop. The U.S. consumers benefit from lower oil prices. U.S. energy firms' stock prices do not. Besides, excessive oil price volatility is bad for producers and consumers alike because it hinders sensible investment and consumption decisions. Making matters worse, it is now clear that the quote-unquote benefits of last year's tax cuts have accrued almost entirely to the corporate sector, rather than to households in the form of higher real inflation-adjusted wages. That's yet to come, Mr. Rubini. That means household consumption could soon slow down, further undercutting the economy. Actually, I would argue the opposite effect. I would argue that the lack of foreign labor coming into the economy here is going to readjust the value of local labor. And as people are being offered more money to actually go work for other people, because their labor is actually more valuable, yeah, you can follow it from there. Continuing on, more than anything, though, the sharp fall in U.S. and global equities during the last quarter is a response to Trump's own utterances and actions. Even worse than the heightened risk of a full-scale trade war with China, despite the most recent truce agreed with President Xi Jinping, are Trump's public attacks on the Fed, which began as early as spring of 2018 when the U.S. economy was growing at more than 4%. The Fed was going to do what the Fed was going to do anyway. They are to some extent independent of the federal government, and that's a good thing to some extent, but it can express as a bad thing because they have their own interests to attend to too. Anyway, continuing on. Given these earlier attacks, markets were spooked this month when the Fed correctly decided to hike interest rates while also signaling a more gradual pace of rate increases in 2019. Most likely, the Fed's relative hawkishness is a reaction to Trump's threats against it. In the face of hostile presidential tweets, Fed Chair Jerome Powell needed to signal that the central bank remains politically independent. But then came Trump's decision to shut down large segments of the federal government over Congress's refusal to fund his useless Mexican border wall. And I disagree with you there, too, Mr. Rubini. Anyway, continuing on. Not on the necessity of the wall. I think that, to some extent, countries do have borders. And you got to have something that delineates one from the other. I'm not saying that a wall is the best way to do it, but there is a border there, and you gotta do something. Anyway, continuing on. That sent markets into a near panic, and the government shutdown was soon followed by reports that Trump wants to fire Powell, a move that can turn a correction into a crash. Just before the Christmas holiday, Treasury Secretary Steven Mnuchin was forced to issue a public statement to placate the markets. He announced that Trump was not planning to fire Powell after all, and that U.S. banks' finances are sound, effectively highlighting the question of whether they really were. Recent changes within the administration do not necessarily affect economic policy making, are also rattling the markets. The impending departure of White House Chief of Staff John Kelly and Secretary of Defense Jim Mattis will leave the room devoid of adults. No, that it'll leave the room probably devoid of warhawks. Continuing on. The coterie of economic nationalists and foreign policy hawks who remain will cater to Trump's every whim. As matters stand, the risk of a full-scale geopolitical conflagration with China cannot be ruled out. No, I think he's more interested in doing business with them than bombing them. A new Cold War would effectively lead to deglobalization, disrupting supply chains everywhere, but particularly in the tech sector, as the recent ZTE and Hawaii cases signal. At the same time, Trump seems to be hell-bent on undermining the cohesion of the European Union and NATO at a time when Europe is economically and politically fragile. They want to be Europeans of their independent countries, not the EU. And Special Counsel Robert Mueller's investigation into Trump's 2016 election campaign's ties to Russia hangs like a sword of Damocles over his presidency. No, it doesn't. There's more to indicate there was collusion between Hillary and Russia than Trump and Russia. Trump is now the Dr. Strangelove of financial markets. Like the paranoid madman in Stanley Kubrick's classic film, he is flirting with mutually assured destruction. Now that markets are in danger, the risk of a financial crisis and global recession has grown. And I followed this up because it seemed like the article was indicating something about stablecoins. Oh yeah. Well, this is a reflection on Rubini. And we might actually cover it. I'm not entirely sure. But anyway, I think there are just a couple points where I disagree with Mr. Rubini there. And I think it's because I disagree primarily with the underlying assumptions with regard to the effects or the intended effects of Trump's moves. See, I think one of the reasons why he's retracting from a globalist empire and running that is that the U.S. military is one of the biggest consumers of oil on planet Earth. The projection of force that we have all over this planet takes a lot of fucking energy. I think we account for something like 30, maybe 40% of like global oil consumption or some shit like that. I read some outrageous numbers, and it was saying, you know, between all of the ships and all of the tanks and all the guns and all that other shit, that the demand for petroleum products from that represented so much of the market that if there were some major fuel disruption, you know, where for whatever reason fuel went up to like between $5 and $8 a gallon, it would get really, 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 really fucking expensive to maintain that grasp over the planet. Those 190 official military bases strewn all over the fucking planet would come to a standstill because they don't have enough gas to keep running. This is a reality. This is not fiction. And like I said, fracking, you got like, I mean, we've been running on it for like 20 years now, or 20 or 30 years. You know, all of our domestic shit, or way more of it than should be, has been coming from fracking. And as I recall, Mr. Obama did tap the SPR a few times, and so the possibility that we have the contingency oil there at a time when we would actually need it, you know, such as a conflict between the U.S., Iran, Russia, and China against the U.S. on Iranian soil. Yeah, I'm sure that somebody was looking at the logistics of that and saying, you know, if gas gets to $10 a gallon, we're completely fucked. It's just fucked. You just have to turn the lights out, have to turn the motor off. And so I think the realignment that Trump is doing right now is a recognition that we can't actually project and maintain the projection of force into the next century. There are certain technological realities that have changed, and also a focus of economy that has changed vastly since the neocon warhawks thought that dream up back in the I want to say like 50s and 60s, and been projecting it forward into the 21 or 2000s. And yeah, the practicality of it, even back in 2001 when they initiated the war on terror, even then it was kind of obvious that we wouldn't be able to handle that kind of thing, that kind of engagement. And I think really the only reason that we've been able to do it into this decade has been stolen oil. And like I said, you know, now that Russia and China are taking a direct interest in restabilizing areas of Syria and probably moving next to Libya, not going to be really easy to gank 55-gallon barrels of oil and selling them into Turkey. Not going to be too easy. Everybody else has satellites in the sky too. They can see the shit going on. It's not all that hard to track your shit down afterward. And so yeah, I think that's one of the things that's going on, that it creates an underlying assumption. You know, if you look back on our oil consumption for the previous decade, and you project out with the assumption that you have a handle on Iraq's oil, Libya's oil, Syria's oil, Yemen's oil, Somalia's oil, and you got that big ass oil pipeline running through Syria. You know, if you can be assured of that underlying assumption, yeah, sure, we can handle another decade of fucking adventurism in securing the rest of the world's oil. But looking forward from where we're at right now, that's not all that fucking likely. You know, and especially considering what I've been talking about with regard to the oil consumption of our projection of force abroad. And I think really the writing's on the wall with that. And as far as people transitioning to more technology here, you know, that does take time, but it's like cumulative. Once you make the steps forward, you don't really make a whole lot of steps back. It's like not many of you are looking at a blue and white screen right now. You know, not many of you are running DOS or a text-based operating system. You're looking at a fucking graphic user interface. So once you made the transition up into a desktop, up into a tablet, up into a sophisticated smartphone. There's very few points where you step back. I can still see a few points where there have been some pressures from the market to adjust certain things, and we're kind of enjoying the way that we're interacting with our hardware right now, and we want to maintain things like a physical removable optical drive on our laptops and on our desktops, that we can put discs in and share media with one another via direct person-to-person in contact. And I know there's been kind of a drive to push that away. Like I guess the latest Xbox doesn't actually have a physical media slot. To me, that's a fail. And it's just a fail, because it's saying I don't trust you enough to, when you like a game or enjoy playing a game, that you will actually buy it. No, I'm going to be a fucking asshole to you so you can't share your media with anybody. It's a fail. It's just a fail. Anyway, let's go ahead and throw back down into some music. It has been a little while. It's probably going to run just a teeny tiny long on it. I don't know. And as far as what we're going to play, I like this song by Megadeth, Kick the Chair, here on Coin Metal. And that was Tool with Schism. And this has been floating around on my browser, and I've been dying to fucking read it to you guys, because I've been talking about this on this show for, I want to say, I know I covered it the last episode, at least a little bit. This isn't on ccn.com. I want to check and verify, though, to make sure it's not just a fucking aggregated fucking story. Nope. Looks like it might actually be original. Lawsuit targets Nvidia for, quote, false statements on crypto mining revenue. A class action lawsuit has been filed against tech giant Nvidia, with the plaintiffs accusing the company of making misleading statements about how it can help mitigate the effects of reduced demand from the cryptocurrency market. The suit was filed by Shaw Law Firm, who specializes in shareholder rights litigation and securities-related class action lawsuits. Last year, the cryptocurrency market was in a prolonged with the prices of mining rigs and PC graphics processing units reaching astronomical levels. Mining rigs were in high demand and were sold at high prices, with everyone from random purchasers of rigs to large companies snapping them up. This led to shortage of rigs, leaving manufacturers like AMD and Nvidia with no option but to increase their production to help meet up with increased demand. However, when the crypto market came crashing down, demand for mining rigs plummeted and prices for hardware sank. The reduction in demand left manufacturers like Nvidia with large inventories collecting dust. To unload the rigs, manufacturers began to flood the market, dropping prices even lower in a bid to recoup their investment. With its oversupply, Nvidia saw rounds of losses in the stock market, and by December 21st, the company was the worst performer on the S&P after it experienced a massive sell-off of its shares, dropping its stock price by 54%. According to the lawsuit, which was filed on December 24th, Nvidia claimed to be, quote, masters at managing their production channel, while also stating that they will be able to ensure proper monitoring of activities in the crypto market. Nvidia was also accused of assuring investors that they will absorb the effects of reduced demand for mining rigs by crypto miners with the strong demand in the game industry. The claim further reads, quote, Based on these facts, the company's public statements were false and materially misleading throughout the class period. When the market learned the truth about NVIDIA, investors suffered damages. According to the release, the case has not yet been certified, and potential plaintiffs won't be given any representation until the certification is secured. For now, the Shaw Law Firm is encouraging investors who bought shares from NVIDIA between August 10th in 2017 and November 15th, 2018 to get in touch with them before January 19th, 2019. So yeah, you got about 2 weeks. Oh, let's see. But yeah, that's something that I've been kind of anticipating. I mean, not actually materializing in this form, but I did have some questions as to how much of NVIDIA's, oh gosh, it looks like this shit froze on me. Oh, it's okay. I'll just reboot the bad boy because apparently it kind of dogged out on me a few minutes ago. That's okay, it happens. And we'll just change that to that and that to that, and we are live again. Anyway, as I was saying with regard to NVIDIA, they've been downplaying how much their revenues have been, how much of their revenues have been coming from cryptocurrency mining, and I don't feel sorry for them if they're actually called to account for it, because in my mind it actually probably had something to do with the whipsawing of cryptocurrency interest, because potential investors are looking at the reports that NVIDIA is giving and saying, oh well, mining really isn't all that big a thing, because NVIDIA is making all kinds of sales, but according to them it's a negligible amount of their supply that's actually going to miners. Now, everybody in the world who games, who is a serious gamer, knows this to be bullshit. They know from going to their Best Buy and other places and seeing the supply drought for that's happened several times over the last, I want to say, since about 2013, 2014, when GPU mining became a thing. There's been periodic disruptions in the supply of GPUs to the market, and it was becoming more pronounced over the last, I want to say, year or so. And so the drop in cryptocurrency prices did cut back a lot on the interest in mining, and that also cut back the interest on renewing people's hardware. The GPU miners that are out there that are, medium and small scale, they're looking at the total availability of GPUs out there, and they're like, yeah, the prices are kind of moderate right now, and on the horizon I'm looking ahead, and I probably won't be able to afford to roll over to the next iteration of hardware that comes out, but the iteration after that will probably be more efficient enough that I can probably see an appreciable gain if I were to transition over to newer GPUs then. And I think that's been some of what's going on with the die down in mining, especially on the Bitcoin network, because we had noticed the dip, and I had commented about it on this show, but what I didn't comment about, or at least haven't commented about yet, was the fact that Bitcoin's hash rate is actually back up to over what it was before the dip. That the race for mining for coins at the end of the block has actually increased. And so when people are looking at the prices of Bitcoin, I think the prices of Bitcoin are going to go up, because the expectation of the miners that are coming online is to make profit. And so they're going to be holding onto their coins a little bit longer and not be so quick to just sell them off to the highest or the lowest bidder or highest bidder, or whatever the fuck they're using as their criterion. But yeah, that they won't be just selling them off, that they will be retaining them for a longer period of time. And I think that in conjunction with this quote unquote, proof of keys bullshit, I think that one is kind of a boondoggle that only certain people are actually participating in. I don't know. Maybe more people are than I'm aware of. Either way, I think the supply constraint that plus of course miners hodling a little bit more than normal might cause Bitcoin to go up a little bit in value. You never know. But I did notice something today that on the pages that show all of the prices of the top like 10 or whatever, it looks like they're all up right now. So, I mean, that ought to tell you something about all the fudding and whatnot. Oh, that's kind of interesting. Bitcoin 2Gen. Never even heard of that, but it's got a fucking market cap of $12 billion right now, so that's interesting. I've never even heard of this fucking thing. It's Bitcoin spelled with two I's and then 2Gen. B2G is the ticker on that. And looking at the chart, it was a flat line and then a huge rise. But it hasn't seen any change in the last 24 hours, so that's kind of interesting. How did it become $2 billion in that short a period of time? I don't know. I'm going to have to look it up. B2G. I'm probably not going to cover this on this show, but, it's kind of interesting nonetheless. I mean, because it's over like Stellar, Tethertron, all kinds of other coins. So, that's pretty interesting. But yeah, I've been anticipating that Nvidia would see some sort of issue. And earlier, I guess right before Christmas, as a matter of fact, there was a major dip in prices for GPUs, and I found one that's a relatively new card, 8 gig card for $179. That's fucking dirt cheap. I mean, you get like 6 to 8 of those together, I'm sure you could probably make some money on it. Especially with new coins. Oh wow, this is weird. This is fucking weird. They're using this almost the same exact color layout of Bitcoin.com. Their ticker is bitcoin.com/English. This is fucking weird. The world's first self-sufficient cryptocurrency ecosystem. That's kind of interesting. I was actually going to cover another coins white paper today, but not white paper, but that thing was kind of bold. That's really weird. Let's look at this. I'm trying to find out some more details on this thing because, let's see, merchant acquiring, Bitcoin 2G announces video training program. It's kind of interesting. I mean, this coin just came from nowhere and it's worth $12 billion. The fuck? How does that work? This calculations of its mining profitability and all that business. This is fucking weird. Create a B2G wallet, B2G mining profitability exchange listing. But yeah, it looks a lot like the Bitcoin.com website. And Bitcoin.com kind of supports Bitcoin Cash and all that business. Technical white paper, that's what we wanted to look for. It's only about 13 pages. Might be able to get down through it. Anyway, let's get to it. Bitcoin B2G technical white paper. Abstract. This white paper describes Bitcoin B2G generally, then presents granular descriptions of elements of the Bitcoin algorithm, which is an implementation of the Ethereum algorithm. The Ethereum algorithm is described at a general level. Some utilities are described emphasizing user benefits, Transactions using Bitcoin B2G holders and between Bitcoin holders and third parties are described with general reference to Bitcoin's trading platform. Blocks in the coding protocols are described. Finally, Bitcoin's mining process is described. General description. Bitcoin, B2G hereafter Bitcoin, is a cryptocurrency based on the eHash algorithm used by Ethereum, with a proof-of-work implementation very similar to Equihash, as used by Bitcoin Gold. Bitcoin B2G begins at a genesis state, s equals 0, and incrementally executes transactions to transition a ledger into a final state, s equals n. The state represents the information about the accounts holding the coins. A valid state transition is one which comes about through a transaction. Transactions are collated into blocks. Blocks are then claimed together using a cryptographic hash as a means of reference. Blocks function as a journal, recording a series of transactions together with the previous block, and also an identifier for the final state. Each block does not store the final state itself, since a complete journal like that would be far too large. Blocks also punctuate each transaction series with incentives for nodes to mine. The incentivization takes place as a state transition function, adding value to a nominated account. Mining is the process of dedicating effort working to bolster one series of transactions, a block, over any other potential competitor block. It is achieved by a cryptographically secure proof. The scheme is known as proof of work. Proof of work is the backcoin of not only Bitcoin, but also most of the decentralized consensus-based transaction systems that have been built to date, such as Bitcoin. The mechanism behind proof of work is a breakthrough because it simultaneously solved two problems. First, it provided a simple and moderately effective consensus algorithm, allowing nodes in the network to agree collectively on a state of canonical updates to the state of the Bitcoin ledger. Second, proof of work provided a mechanism for allowing free entry into the consensus process, solving the problem of prioritizing who gets to influence the consensus while simultaneously preventing Sybil attacks, or at least making them really, really hard. It does this by substituting a formal barrier to participation, such as the requirement to be registered as a unique entity on a particular list. Built upon the foundation of the Ethereum consensus-driven blockchain, Bitcoin's blockchain operates perpetually censorship-free and collusion-resistant. Blockchain technology is hardened against tampering and revision with the unanimity of records hosted by every node equally. Transactions, contract code storage, and code execution fees are recorded on continuous blocks on the network ledger, cryptographically secured and time-stamped. The peer-to-peer validation model of blockchain transactions has been proven elsewhere to be and is self-governing. The mining process incentivizes proof-of-work effort through the awarding of block rewards and transaction fees paid to mining participants. Ethereum algorithm. The Ethereum algorithm uses accounts and balances to record state transitions. The recording function does not rely upon unspent transaction outputs, UTXOs. The state denotes the current balances of all accounts plus extra data. The state is not stored on the blockchain, but on a separate Merkle Patricia tree. I wonder what that does to confirmation. A Merkle Patricia tree provides a cryptographically authenticated data structure that can be used to store all key value bindings. In the context of a cryptocurrency, our use of the term is confined to strings. The Patricia trees are fully deterministic, meaning that a Patricia tree with the same bindings is guaranteed to be exactly the same down to the last byte, and therefore has the same root hash. This consistency provides O times log to the n efficiency. O times log times n efficiency for inserts, lookups, and deletes, and that application allows easier coding. The benefit of this implementation of Patricia trees comes with the addition of some complexity to the data structure. A nonce in the Merkle Patricia tree is one of the following: null, represented as the empty string; branch, a 17-item node, V to the O through V to V15, V to VT; leaf, a 2-item node, encode, path, and value; extension, a 2-item node, encoded, path, and key. The result of this implementation is optimized throughput. A thorough presentation of the use of trees throughout the Ethereum blockchain is beyond the scope of this paper. Utilities. A cryptocurrency wallet stores public and private keys or addresses which may be used when an owner of Bitcoin wishes to receive or spend the coin. These address keys can be generated through BIP39 style mnemonics for a BIP32 HD wallet, but Bitcoin, using the Ethereum algorithm, does not operate in a UTXO scheme. With the private key, it is possible to write in the blockchain, effectively making a transaction. To send Bitcoin to an account, the holder needs the public key of the destination account. Bitcoin accounts are pseudonymous, meaning accounts are not linked to individual persons, but rather to one or more specific addresses. Owners can store these addresses in software or on paper. Bitcoin follows a unique address format, which is the same as Bitcoin Gold and some other major cryptocurrencies. Addresses. Bitcoin's Ethereum algorithm addresses are composed of the prefix 0x, a common identifier for hexadecimal concatenated with the rightmost 20 bytes of the Keccak 256 hash, Big Endian, of the ECDSA public key. In hexadecimal, 2 digits represent a byte, meaning addresses contain 40 hexadecimal digits. One example is OXB794 lowercase F5EAOBA blah 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 blah. I'm not going to read the whole address. The Poloniex cold wallet. Contract addresses are in the same format, however, they are determined by sender and the creation transaction nonce. User accounts are indistinguishable from contract accounts, given only an address for each and no blockchain data. Any valid Keccak-256 hash put into the described format is valid, even if it does not correspond to an account with a private key or a contract. That's interesting. Comparison to Bitcoin. Bitcoin, like Ether, is different from the original Bitcoin in several notable aspects. Number 1. The block posting interval is 14 to 15 seconds compared with 10 minutes for Bitcoin. Number 2. Mining Bitcoin generates new coins at a usually consistent rate, occasionally changing during hard forks. Number 3, transaction fees on Bitcoin differ by computational complexity, bandwidth use, and storage needs, while Bitcoin transactions compete by means of transaction size in bytes. Actually, they do it by price now. Number 4, Ethereum gas units each have a price that can be specified in a transaction. Bitcoin transactions usually have fees specified in satoshis per byte. Number 5, transaction fees are generally considerably lower for Bitcoin than for Bitcoin. In December 2017, the median transaction fee for Ether corresponded to 33 cents, while for Bitcoin it corresponded to $23. I know I was there, and yes, it did. It sucked. Number 6. Bitcoin's implementation of Ethereum uses an account system where values in Bitcoin debited from accounts and credited to another, as opposed to Bitcoin's UTXO system, which is more analogous to spending cash and receiving change in return. Both systems have their pros and cons in terms of storage space, complexity, and security/anonymity. I think this is number 7. Bitcoin was built on to rely on proof of work, not proof of stake. This is what makes Bitcoin B2G a second-generation token. The Bitcoin algorithm is similar to the one used by Bitcoin Gold. Thus, miners using GPUs to mine Bitcoin Gold can use the same GPUs to mine Bitcoin, requiring a minute or no changes. Implications for users. Bitcoin's use of the... Oh wait, we're actually running out of time here. We're just going to finish this last one here. Bitcoin's use of the Ethereum blockchain provides a block refresh rate of 14 to 15 seconds. This refresh rate reduces the blockchain's exposure to Sybil attacks and other mischiefs substantially, as compared to the original Bitcoin's posting rate of approximately one chain per 10 to 12 minutes. And we're going to cut it off right there. If you want to look it up, this was Bitcoin, spelled bitcoin.com, and you can find their white paper there. It's kind of mildly interesting. It's something about this is actually what I was describing earlier, or it looks like something I was describing earlier. I haven't gotten but like about halfway through their white paper, so it could differ radically in the second half. We just don't know. Anyway, what I was saying earlier about the market getting self-reflective, where we look back over lessons learned over the last decade and we try to apply them to new coins. And I think that's kind of what's going on here. They're using several elements of existing projects and trying to make something better. And that's commendable. And again, though, I'm not sure how the rest of it measures up to existing projects, so I won't comment as far as its possibilities of success or anything like that. All I can say, though, is it appears as though they're actually trying to do something unique with existing ideas, and by linking them in possibly unique ways. We don't know. We'll see. And just to let you know, this wasn't to pump them or anything. This is just, PSA kind of shit. I never say, you should or you should not do this unless I'm talking about something off-chain, but that's a whole different topic for a whole different time. But yeah, so, I don't know. These guys, the one thing that makes me feel kind of scammy about them is the presentation of their website, because it looks a great deal like Bitcoin.com's website, and so trying to kind of piggyback on the reputation of other coins and stuff and known entities within the cryptocurrency space, I think it's one of those things of trying to associate the values of somebody else's project to your own, and the fact that they're copying a lot of projects in the design of their project itself, that too also lends to that suspicion. But again, it'll all depend on how it's actually utilized. Whether or not people are actually mining it, whether or not vendors are actually using it. These are where the rubber hits the road. And so I don't know about its its existing $12 billion market value. That'll, I don't know. Like I said, that's something that the market will have to decide on its own. And it is with that I'd like to close out this episode. Thank you very, very much for listening. I certainly do appreciate the support. And as far as The Last Dance is concerned, I'm not entirely certain where I want to go with that. Let's see here. We haven't played any Clutch today, and I'm kind of digging the Book of Bad Decisions, although I gotta say it's a little too bluesy, kind of rockish for me, although I do like one or two of the songs quite a bit. And so this one right here, I will say this though, the production value on it is fantastic. It's a really quality recording, and you get a lot more than just the CD if you do buy it, the physical form. But nonetheless, here it is. How to Shake Hands. Clutch from the Book of Bad Decisions, The Last Dance, here on Coin Metal. And until Friday, I'd like y'all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. Not even Norio Rubini. Thank you again for listening, and y'all have an excellent evening.